Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Hello, I'm Sabin, Saveluc, an Associate Director in EMEA's Investor Development Team, and today I'm joined by Redmond Ramsdale, Fitch's Head of Middle East Banks. And today we're discussing Fitch Ratings' latest commentary on the GCC banking sector and the US-Iran ceasefire, and we'll examine it in greater detail where we are in terms of the sector resilience. So Redmond, welcome. To start, can you tell us how GCC banks have fared during the conflict and what should we expect for the second half of the year?
Yes, thanks, Sabin. GCC banks' credit fundamentals have proved resilient to this conflict. So GCC banks entered the conflict in a position of strength. Capital and liquidity buffers are strong. Asset quality metrics are good and markedly strong by historic standards. And we expect this to remain the case in the second half of the year, assuming no resumption of the military conflict, or at least one where there's no lasting damage to energy infrastructure or to other key GCC assets, also where there is no significant prolonged closure of the Strait of Hormuz. Now, if the ceasefire holds, we expect the impact to stem from the second-order macro effects. So we forecast non-oil GDP growth to contract in 3 of the GCC countries, namely Bahrain, Qatar, and the UAE and Abu Dhabi, and to be weaker in Saudi and Kuwait. It's only Oman where our 2026 forecasts are higher than 2025. So for the banks, this means lower loan growth than we anticipated in our 2026 sector outlook. And this will be alongside moderately weaker asset quality and profitability.
Okay, that's interesting, as the key theme here seems to be resilience. But how does that marry up to Fitch's change in sector outlook for Middle East banks to deteriorating from neutral in our mid-year update?
Yeah, good question. So the sector outlook is quite distinct, for instance, from our ratings outlook. And the deteriorating here reflects the war and the adverse macroeconomic inputs that I just talked about, i.e. lower loan growth compared to last year and this moderately weaker asset quality and profitability.
Sure. So can you take us through what rating actions there have been since the start of the conflict for the banks?
Absolutely. So it's important to point out here that over 85% of GCC banks' long-term issuer default ratings are actually driven by government support. And the only rating actions that we've taken due to the conflict is to place all Qatari banks onto rating watch negative, and this mirrors the rating watch negative that was itself put onto the Qatari sovereign.
So let's go back to the transmission channels. Can you walk us through this in a bit more detail?
So at the start of the conflict, we talked about 2 main transmission channels, and that is asset quality and funding and liquidity. So asset quality will be moderately impacted by weaker performance of borrowers in sectors such as infrastructure, tourism, aviation, logistics, transport, real estate. But if we look at things like tourism, banks generally have a low exposure here, less than, say, 3% of banks' books. SMEs is also a segment that will be less able to cope with asset quality pressure versus larger corporates. But again, bank SME exposure is generally quite small. And then to funding and liquidity, generally this is a rating strength for banks in the region. GCC markets have largely retraced from that initial sell-off triggered by the start of the conflict. The largest issuers have now returned to the public debt markets after that initial pause. And this is especially in, for instance, the subordinated space. And now we're seeing sort of really a minimal added risk premium on this issuance.
Okay, so can we move on to the support packages we saw coming from some of the GCC sovereigns for their banking sectors?
Yeah, absolutely. So the announced forbearance packages from some central banks, namely the UAE, Kuwait and Qatar, were really preventative measures designed to boost confidence and to limit the pass-through effects of temporary deposit volatility, and were not because of acute banking stress. And this is very consistent with the regional authorities' sort of strong track record of support.
Thank you, Redmond, and thanks to everyone for joining today.
Subscribe to Fixed Interests wherever you get your podcasts.